Today we are going to answer the question, what's more important, obvious market signals or invisible market signals? So let's jump right into it and explore the options. So the obvious market signals are things like floor trader pivots, yesterday's high, yesterday's low, yesterday's close, the 50-period simple moving average and the 200 simple moving average on a daily chart, previous major swing highs and lows, and by that I mean ones that just pop out of the chart. You're looking at a chart and they just really catch the eye. Anybody would just immediately recognize, okay, there's a high, there's a low, very, very obvious ones. So the obvious market signals are things that everybody sees. So for example, those floor trader pivots, those are not relative levels. Those are very concrete numbers. Those are numbers. They're going to be the same on everybody's chart, whether you're trading on a 5-minute chart, a 30-minute chart, a 144 tick chart, doesn't matter. Those pivot levels are going to be the same on everybody's chart. Same thing with yesterday's high, low, and close. Those are concrete numbers. They're not relative, so they will be the same on everybody's chart. Now you notice I put for these moving averages on a daily chart, and that's because the 50 and 200 moving averages are not moving averages that everybody puts on every interval of a chart. But on a daily chart, they are the most common moving averages. And in fact, also a lot of computer programs that trade use these two moving averages. So in this day where a lot of computers are actually trading, probably over half of the trading volume is done with program trading, very important to take computers into account as well. And all of these things are taken into account with various types of computer programs. Now, of course, each program varies, but still, these are things that are quite often taken into account. Same thing with previous major swing highs and lows. And we're going to make a distinction here in just a moment about that. But again, this one is maybe a little more subjective, but I'm talking about the ones where anybody would look at a chart and just immediately says, oh yeah, there's a high, there's a low. It immediately catches everybody's eye. And that's the key here. These obvious market signals are things that everyone sees and therefore everyone reacts to. And they are very, very important. So to answer the question, these are critically important. The market is like an auction place, and so whenever you get a lot of people reacting to the same thing, in this case the same levels on a chart, that's very important. And you better have these levels on your charts, because the market will react to them, either buy off of them, sell off of them, short off of them, take profits into them, and you better know where these levels are. Yes, they are extremely, extremely important. Now, before we get to the invisible market signals, I'm actually going to show you kind of an in-between category that I call flexible market signals. These are important. They can be used effectively, but they're not quite as important as the ones we just looked at. So, for example, moving averages of any type, other than the two obvious ones we already talked about that are so commonly used. Moving averages are very flexible market signals. So, for example, not everybody uses a 50-period or 200-period moving average on an intraday chart. Some people use 9-period moving averages, some use 20, some use exponential, some use simple, all kinds of things. 89-period moving averages, all bizarre numbers, Fibonacci numbers, and then, some people use it on a 2-minute chart. For example, you might get a person who says, well, okay, I use 20-minute or a 20-period moving average. They use it on a 5-minute chart. Someone else also uses a 20-period moving average, but they're using it on a 89-tick chart. So even though they're using the same moving average, going to be different values because they're using it on different scale charts. So moving averages are not giving the same concrete number on every chart, and therefore the masses are not reacting to most moving averages. Fibonacci levels, very, very popular. Lots of people use Fibonacci levels. They are important. I use them too. But they're flexible market signals. They are not concrete numbers in the sense that they are not the same numbers on every single person's chart. And again, it's for the same reason. One person's using a 2-minute chart, another one's using a 30-minute chart, another one's using a 144-tick chart, and they'll draw them off of different highs and lows. And so those actual numbers of those levels will vary from one person's chart to another. Again, swing highs and lows. These will be varying depending on the person's chart interval. So other than the really, really major ones that stand out that will actually transcend interval, there are some that will transcend interval just because they're so big. But all the little minor ones and even the medium swings, those will all vary depending on the chart interval that people are using. And finally, candlestick patterns are flexible market signals. A hammer that you see on one chart, on a different time frame, you're not going to see a hammer. You're going to see a different candlestick pattern. And so again, those will vary from one chart to another. And so that's the thing here, that these are things that most people see, most people watch, many people use, but the actual value that is created will vary depending on the different scale or the different time interval of the charts that they use. Okay, now let's go to that other market signal that we talked about at the beginning. That was the second part of our question. And these are actually the invisible market signals. These are the ones that most people don't see at all in any way, shape, or form. So, this includes indicators most people don't watch. For example, proprietary indicators that are not included on most charting platforms that you have to purchase. So most people, the vast majority of people, they don't even have access to them. That would be one invisible market signal. Another one would be indexes that people don't watch. And again, there's a lot of indexes that are very important that most people just are not watching. Some of them are statistical indexes. For example, they're not just watching a particular market like the Dow or the S&P, but there's statistics regarding the market that a lot of people don't even watch. And so they're invisible. Essentially, anybody could see them, but most people aren't watching them, and so they are, in a practical sense, invisible to most traders. A third category here is combination of factors that most people don't watch. So, for example, some traders use a combination of common indicators that maybe a lot of people use, stochastic, MACD, RSI, Bollinger Bands, whatever. But it's the combination, the way that they put those indicators together to find trading signals that most people don't do. And then that becomes an invisible market signal. Same thing with particular indexes and statistics. It's the way you combine them that's very, very unusual. Most people do not look at that. And so, again, it becomes practically invisible to the masses. And then, here's a really, really, really important one. Things that people watch, but they don't know how to read. And I get this all the time. People email me and say, well, Barry, which internal indicators do you watch? You know, do you watch the trend, the tick, whatever? And you know, it doesn't even matter. I could tell them what I watch, but it's not going to make any difference whatsoever to them, because it's not which ones I watch, but it's how I read them. It's the strategy, the technique of how to read them. And how I read them is invisible to the masses. Now, these invisible market signals are really, really important, because these are what are going to give you the all-important edge in trading. This gives you an advantage over the masses. It gives you something that they don't have. So, you definitely want to have an edge in trading. So what I recommend is come and take all my free stuff. I have a free 5-day video correspondence course. You can get it at the website listed there. Come, take it, enjoy it. Enjoy my blog, free videos, free articles, years of great free information there. And if you have any questions, feel free to write me at the email below.